Some stocks are more appealing than others, and I know this because I make videos on this channel. I've made many videos on this channel. Some stocks will perform much better than others because people are interested in them. However, one thing all of you who are clicking on this video are interested in is making money, and these stocks are doing particularly well. They are. Maybe you don't know this because it's a name you might just normally skip over. But this is the first one, American Express, right? The last 5 years up 173%, but we can see it's basically doubled since late 2023. So what, 14-ish, 15, 16 months? It's basically doubled in that time frame, more if you include dividend. It's done very, very well. And I got in somewhere in the middle of 2024. It's been doing particularly great. And also, its PE ratio is still relatively low. 21.5 there. Let's see what the forward PE is. Just under 20. So compared to the broader market, which is at about 30, this is still a company that has room to grow. If you look at Visa and MasterCard, I have these three as the juggernauts: Visa, MasterCard, American Express, at least in the credit card market today. They are so consistent with earnings. They are. They grow, they grow, they grow, they grow. People are not going to stop using credit cards anytime soon. American Express, it might not be the most quote unquote attractive. It might not be super exciting, but American Express in the long term, if you hold this, is going to make money. And honestly, I still think it has plenty of room to run, even in the short term. I don't know if it's going to do that, but I wouldn't be surprised at all. This is a good company. Maybe not the most interesting. It does have a cap to its ceiling. You aren't going to have an NVIDIA run on it, and that might make some of you choose not to invest in this. However, it's a very well-run company. It's been doing very well lately. I wouldn't be surprised if it keeps going up. Morgan Stanley is another one I'm going to take a bit of a victory lap on. I've been making videos on this channel since October, early October. Morgan Stanley was one of the first ones I made. I've tried to make a couple of videos on Morgan Stanley. Literally no one cares. That's okay. But I'm here to tell you, I've done well in Morgan Stanley. It's been doing well. It's a very, very, very well-run company. It's been on an incredible run. 200% in 5 years for a company that isn't tech is very, very impressive. Not even trying to mention, look at this, forward dividend yield, nearly 3%, 2.75%. When I bought it, it was closer to 4%. So even if this ran stagnant for a while, you're still getting nearly a 3% dividend yield. And that's almost dividend, portfolio threshold. Kind of the bottom of that would be 3.5%. But this is a company that's done incredibly, incredibly well. I mean, going back to 2015, early 2015, you're up from 35. You've basically 4x'd. You're doubling the S&P 500 performance. You're still relatively cheap, although all these financial institutions are relatively cheap. Your forward PE is 15. So like I said, you have to really look at peers because there's almost no large financial institutions. I know they focus primarily on helping people invest, but they're still, in my opinion, a financial institution. You don't see them trade above an 18, 19 PE. It just doesn't happen. So to say this, it's incredibly cheap, it could run up to 30, I think that's a bit disingenuous for me to say that because it would be pretty remarkable if that happened. We haven't seen any financial institution run near that high PE since, the 2007-2008 financial crisis. So I don't expect it to do this. However, the rate they've been growing, you don't need 30 PE. You don't need it to double in PE to make good money. You can make good money on Morgan Stanley just as it is. And like I said, that's what you clicked on. This video isn't about super exciting AI stocks. It isn't. It's about Morgan Stanley, it's about American Express, and the last company I'm talking about that have done very, very well and are probably going to continue to do well in the future. And it may not be, I hold this cool stock, Morgan Stanley. No one really cares about that. However, I can tell people that I talk about stocks with and be like, yeah, Morgan Stanley's been incredible for me, and I've been saying it basically since I've held it. It's done incredibly well. I think it's going to continue to do incredibly well. So here's our last boring stock of the day. Here it is, Lowe's. It hasn't been quite as impressive as the other two. It's still outperforming the S&P 500 of about 133%, and you get a dividend yield that is higher than the S&P 500 as well. Lowe's is a very well-run company. They are, and they're in an industry, there's really only two names in it. It's Home Depot and Lowe's. I own both. I want all of it. Houses that are built, they use supplies from either Home Depot or Lowe's. It's just how it works. That's how it's going to be for the future. Now you may say, well, I don't think homes are going to be being built anytime soon. I think rates are going to go up, whatever it may be. There's some of you watching this video that definitely think that. However, this, in my opinion, is more of a long-term hold. I want to own Lowe's. I want to own Lowe's for the long term. It is going to make money. It will. It may not be next year, but a year from now. And it's so hard to time these sorts of things. If we knew exactly where rates were going to go, I would tell you to do things differently because you could exactly time everything perfectly. It would be really easy, actually. You would know exactly how to allocate your money beforehand. No one knows that. And I would rather be early than be late, because if you're late, you missed. I made a video on this called I Made a Mistake. Scroll down maybe a week and a half ago in my video feed. I knew a stock was fairly cheap. I talked myself out of it. I delayed it a couple months. I delayed it 6 months, and then I missed the boat. I knew it was going to go up. Well, I wasn't certain, but I was pretty sure because I knew it was cheap. Same thing with Lowe's. Lowe's is going to do well. Even when there's excitement about rates dropping, whatever it may be, whether they start dropping soonish, whether they don't drop for a year and then start dropping, it's going to go up, and home building is going to go. It's just going to happen. Lowe's is going to benefit from it. Home Depot is another, but it's not the most attractive because it's got a ceiling on it. It really does. But this is a company, like I said, 133% over the last 5 years. If you zoom out, it looks incredible. Look at this chart. Isn't this insane? Early 2015. We're from about 60, 70. So 70 would be 3xing at 20. So you've over 3x. You're outperforming the S&P 500, which over the last 10 years, about 10 years is up 200-ish%. Your dividend's higher. You are outperforming the market. You still have a lot of room to grow. 200 or $140 billion market cap. Home Depot, which is in the same field, I think they're close to 300 billion. So you have a lot of, I just really like Lowe's. And if I made a video on Lowe's talking about how much I liked it, none of you would watch it because it's fairly boring. It's a fairly boring stock. It's not tech. It's going to do well. I think so. Of course, I cannot see the future. This is not financial advice. These are 3 stocks I personally own. I expect to do well. They're quote unquote boring. Good diversification. Don't go 100% tech, because if there's a recession, something, you get slaughtered. Hopefully some of the fears we saw that with DeepSeek, a lot of semiconductors fell. We see it with when there was worries about tariffs and things like that. Hopefully your risky stocks fell a bit. You can identify that, diversify out of that if you need to. Of course, if you don't touch it. Anyways, that's all I got for this video, guys. If you enjoyed, like and subscribe. I do daily stock content on this channel, and I'll catch you next time. Thanks for watching.